All right, we are 30 minutes into the U.S. trading day on this Tuesday, April 23rd. Here are the top stories we're following. Tesla's moment of truth. The EV maker reports earnings tonight with shares down 19% over the past week and lower by 43% so far this year. Investors bracing for Tesla's first revenue decline in 4 years. Meanwhile, defense and aerospace are today's bright spot, with shares of Lockheed Martin and GE Aerospace rallying on the back of strong earnings. We'll speak with Greenwood Capital's CIO about his take. And business activity slowdown. Raveen Gandhi, the CEO of GMM Nonstick Coatings, he joins to discuss the latest ISM data, what they say about manufacturers and consumers. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets on this Tuesday, and we have some good news, and that's that stocks are green. You take a look at the S&P 500, actually up about 0.7% so far. If these gains hold, that will be a second straight day of wins for the S&P 500, which feels like hasn't happened in a while. Meanwhile, take a look at big tech. Same story, but a little bit better. The NASDAQ 100 currently higher to the tune of about 0.9%. But as we know, everything can change tonight when we hear from Tesla, finally, of course, kicking off a big week of earnings. And meanwhile, I did want to check in with the bond market. Yields were higher this morning, but now moving a little bit lower. The 10-year yield currently lower to the tune about 2 basis points or so. A very quiet day so far. We'll see if that holds. But let's move from the bond market over to airlines, because JetBlue's nosedive is in focus today, with the discount airline saying that revenue this quarter will fall more than anticipated thanks to bloated capacity in Latin America. Now, remember, last month, JetBlue outlined plans to cut a number of routes in the region, and Bloomberg's Brooke Sutherland has all the details. And Brooke, you take a look at the reaction in shares. It's pretty brutal. At one point this morning, falling by the most since 2020.
Absolutely. And I mean, this has really been the story of the past year for JetBlue, is that they just have too much capacity. It is way out of whack with what the underlying demand trends are, and they were chasing that growth, and it's just not materializing. But I think, the perception had been that this was primarily a domestic problem. You've, of course, heard similar type of commentary from airlines like Spirit, which JetBlue was trying to buy but failed to do so. But I think the fact that this is such a stark problem in Latin America is really what's driving that share pressure today. And this Latin America is a significant portion of JetBlue's network as well.
Yeah, I mean, as you lay out, Latin America, very important to JetBlue, but it's interesting. I mean, we heard from the likes of Delta and United as well. It seems like they're having issues with that region as well.
They are having issues with that region, but those airlines are much more multifaceted. They cater more to premium customers. They have much bigger international operations well beyond Latin America, and they just are better positioned to weather this current environment for the airlines. They, of course, are not immune to the cost pressures that companies like JetBlue are facing, but when you're bigger and you have different lines of business that you can pull on, that just helps you right now. And I think you're really seeing that divide, that disconnect in the airline industry between the larger carriers and those who are more domestically or regionally focused like JetBlue.
And so, I mean, is there anything that we can extrapolate out from this, or is this such a JetBlue sort of specific thing when you think about how dependent they are on Latin America? Is this going to be as big of an issue for some of these other airlines?
I think it certainly signals that there's still too much capacity in the airline industry right now. And you've seen, JetBlue lowering its CapEx goal. You've seen other changes at companies like Spirit rethinking, how it puts planes into its network. And, that does have ripple effects. Right now, the demand for aircraft is so strong, and both Boeing and Airbus just simply cannot deliver them fast enough. And so I think you're still in a good spot as far as new aircraft demand. But certainly it does raise questions in terms of what that trajectory looks like and how that demand pattern shakes out over the course of the next couple of years.
All right, Bloomberg's Brooke Sutherland, thank you so much. You take a look at JetBlue shares down right now by about 14%, certainly an ugly day for that airline. But let's broaden out now, because we're now joined by Walter Todd. He is Greenwood Capital President and CIO. Walter, it's great to have you with me. And let's, again, start broad, and then we'll dial down into some single names. But when we think about this earnings season and the setup going into it, it feels like a lot of jitters have entered into the broad indexes. The S&P 500 definitely has seen some massive declines over the past couple days or so. What are the stakes heading into this real meat of this reporting season?
Yeah, well, good morning, Kay. Thanks for having me on. Yeah, I agree. The setup into this earnings season has been somewhat questionable because the earnings have actually been pretty good so far. About 75% of companies have beaten. 80% of the companies that reported this morning beat expectations, but it's really about the guidance. So you're seeing a lot of companies that are beating expectations for the first quarter, but maintaining guidance for the year, which is kind of a under the radar guide down for the back half of the year. And so there's still a lot of uncertainty from companies when you listen to them, but we're seeing a nice rebound the last couple of days. That was a pretty, significant sell-off, not that big of a percentage decline, but when you look at certain corners of the market, like technology and others that got hit very hard, it's nice to see a little stabilization as we head into, as you said, the meat of earnings with the big names reporting later this week and next week.
And it's been interesting. It feels like even though a lot of companies have fared pretty well so far, it's still early. It feels like misses are especially being punished in this market. Is that sort of the blueprint we should be following for the next couple of weeks?
Yeah, I would say so. I mean, if you look at, let's just take JetBlue, which you were just talking about. I mean, they actually beat the numbers for the quarter, and you would think expectations were fairly low given the stock price performance, but yet the guidance and the outlook were really what are hitting the stock. So again, it's a little bit of a mixed bag. I mean, JP Morgan's another great example. Started the earnings season a couple of weeks ago, had a decent quarter, decent call by my expectations, but the stock was down 6%. So it kind of depends on what the macro backdrop is on the day you're reporting, as well as the guidance that you're providing on a go-forward basis that dictates kind of the stock price performance.
Yeah, it's a great point that, for better or worse, this is still very much a macro-driven market. And what does that mean for this rotation trade that keeps trying to bloom? Of course, we saw a lot of it at the end of 2023. Tech sort of taking a backseat to some of these underloved sectors. And then just in the past month, it feels like we've seen a revival of that trade. Do you think that actually has staying power? And how much does that depend on earnings versus the macro, like you were just saying?
Yeah, well, a couple of things on that. One is it's fascinating to watch this market kind of minute to minute and day to day. Take, for example, the PMIs that were just reported. You saw about an 8 basis point drop in the 10-year yield. And as that happened, you saw a total flip in kind of the makeup of what was working and not working in the market just this morning. So to your point, there is a lot of churn and rotation. And it looked like March was kind of, a widening out of the market that narrowed back down at the beginning of April. And then we had the big tech sell-off, in the middle of this month. So I think it's a combination of the two, right? I think earnings growth for the Mag 7 and the top of the market are kind of very good, but slowing as we move through this year. Conversely, the other 493 or 490 stocks in the S&P are actually seeing or estimated to see an acceleration in earnings as we move through the balance of 2024. So that trade-off, we think, is a good backdrop for companies outside of the quote-unquote top of the market.
Well, to your point, I mean, you take a look at the data that was released at 9:45 this morning. Of course, we're talking about some S&P U.S. manufacturing PMI, services PMI, and the composite PMI all coming in a little bit below expectations. Like you say, a pretty significant drop in yields off the back of that. Stocks shooting higher as well. I mean, it feels like that just goes to show how much this market is really rooting for rate cuts at this juncture and maybe setting up for more disappointment on that front?
Yeah, well, certainly the Fed Fund futures, as I'm sure you've talked about, have dropped from 7 down to 1.5 cuts. November is now the first meeting with a full cut priced in. So it feels like we've kind of moved from one extreme to the other. So I think the truth's probably somewhere in the middle. I do think the Fed kind of wants the cut to kind of try to rebalance the yield curve. But they're waiting for confirmation from the data. So I think if you look at the way the market behaves as rates go up or down, that's kind of your playbook depending on your outlook for the remainder of the year. If you think rates are kind of peaking here, then the setup is for this, a market to maybe broaden out beyond, the top, 7 or 10 names.
And just quickly, what's your base case? What do you think happens here?
Yeah, I think rates are kind of peaking here. I do think we could see some, we get PCE at the end of this week, or we could continue to see some will a little bit hotter prints in the next few months. But I think rates at the end of the year are going to be lower than they are today. So that's kind of our outlook. And I think the Fed will probably get maybe 2 cuts in before the end of the year. So a little bit more than the market's pricing in at the moment.
All right, Walter, sit tight for just a couple minutes. We'll be coming back to you. But before we do, let's take a quick look at what's moving underneath the markets now. We're going to do that with Bloomberg's Emily Grafeo, kicking us off with UPS.
Yeah, I mean, UPS, the stock has kind of been moving around all morning. It's now up about 1%, but you can really see in the earnings that this is a company that's facing softer demand for packages. After the pandemic, less people have been shipping items, at least through UPS. Their profit beat and their adjusted EPS also beat, coming in at 143 versus estimates of 130. But then when you look at the revenue, although it was down 5% year over year. The average daily package volume was also about in line with estimates at 21 million, but it was down 3.6% year over year. And it was interesting, Morgan Stanley said they have an underweight rating on UPS. It appears to be a healthy beat. It might spark a modest relief rally when you look at the earnings, but they doubt that the numbers will come up or that the market is really going to consider this to be a turnaround, just in light of the negative momentum that we've seen with UPS.
Yeah, and maybe we're seeing that modest relief rally right now because 1.2%, not huge, but it is still green. Tell me, though, about what's going on with Spotify. Much more action there.
Much more action. This stock is up about 12%. And this is a company where you can really see that they have increased prices and consumers have reacted positively to it, at least positive for Spotify. The total premium subscribers grew 14% year over year to 239 million, which was about in line with estimates. And the total active users, so that's encompassing both the paying subscribers and streamers with ads, that also grew year over year. And then when you look at the revenue, that also kind of beat estimates just slightly, coming in at 3.6.4 billion versus estimates of about 3.61 billion. Overall, when you look at Bloomberg Intelligence's analysis, they said that the price hikes are driving acceleration in both revenue for Spotify and the average revenue that Spotify can make per user. So overall, a pretty good earnings report and a positive stock reaction.
Yeah, a lot
as
of
well.
good news across the board. Spotify shares currently up about 12.5%. It's a different story if you take a look at what's going on with Pepsi and some weakness, specifically in North America.
Yeah, a weakness there, I guess, as more consumers in North America are facing higher inflation, perhaps pivoting to buying the store
They're paying
bought.
for Spotify.
Yeah, they're paying for Spotify. Yeah. So more pricing power, at least in music streaming, when it versus consumer goods. You look at their North American food and drinks divisions, they sold fewer goods by volume compared with a year earlier. Drinks volumes were down 5% in the region. The EPS beat estimates, the net revenue beat estimates, but it does seem like shareholders are more focused this morning on that volume decline. And then one last thing I'll note, they had a recall for Quaker Foods back in January. I was not aware of this, and I do eat a lot of oatmeal. Cereal, bars and snacks, there was a risk of salmonella, and so we're seeing their Quaker Oats revenue fell 24% in the quarter after that recall.
All right, Emily, great roundup as always. Our big thanks, of course, to Bloomberg's Emily Grafeo. And coming up on this program, tough times for Tesla. We're going to explore what investors will be watching when the EV maker reports after the bell. This is Bloomberg. Well, Tesla investors are on edge ahead of this afternoon's earnings call because shares of the EV giant have plummeted over 40% this year and are in the midst of the longest rout since late 2022. Joining us now for more is, of course, Bloomberg's Ed Ludlow. And Ed, let's start with what's expected to be the first revenue decline in 4 years. How'd that happen?
Yeah, the first revenue decline year on year since that kind of shutdown quarter of the pandemic, where they didn't have a choice, where volumes were low because production was halted. But it's all of the above, right? Revenue, operating income, free cash flow. We know it was a really bad quarter. What's interesting in this stock is that there is a dichotomy between what the institutional investor base cares about and what the kind of like retail investor who also owns a Tesla car and loves Elon Musk cares about. And which comes out on top, I just don't know. It's probably robo-taxi versus how much you emphasize the fundamentals.
And Ed, I mean, we've heard from a few investors who have said it would be thesis changing if, of course, Tesla truly was abandoning its plans or really shifting its focus away from that cheaper car. I mean, just put those comments in context for us. When we think about the shift from the cheaper car to the robo-taxi potentially, I mean, what would that mean?
Yeah, we just need clarity on the earnings call. This probably is one of the most important earnings calls in Tesla's history. You know, the idea of a $25,000 EV that's accessible to all is at the heart of the bull thesis for global Wall Street around Tesla. But again, the dichotomy, the retail investor cares about AI, robo-taxi, autonomy, but we don't have any clarity on that either. So Elon Musk just needs to spell out, is the robo-taxi the single priority now? Or is there still a version of a $25,000 EV that exists? Go and read the big take we put out over the weekend. We tried to explain what's actually happening there. It's a technology initiative, which we believe late 2025, you'll see a cheaper EV, but just versions of existing models like 3 and Y, not necessarily a sort of standalone new model.
All right, Ed Ludlow, you have a busy day ahead of you, so good luck. Appreciate some of your time now, but let's broaden back out this conversation. We're going to bring back in Walter Todd of Greenwood Capital, and let's talk about some earnings that we've already seen, of course, as we count down to Tesla. I want to talk about GE here, raising its earnings goal. It saw strong engine sales. That's a name, of course, that you follow pretty closely. I mean, what was your reaction to what we heard?
Yeah, so I think Larry and team took a very well-deserved victory lap during this call. They were very upbeat about the outlook for aerospace. This is the first call they've had after the multiple split-ups that the company has done to focus in on GE Aerospace. This is a stock that we do own for our clients in portfolios and have owned for a little bit. Brooke, who was talking about JetBlue, we've been talking about GE and the transformation or the evolution of it since she joined Bloomberg News, I think 7-8 years ago. So it's nice to see it finally come to fruition and kind of focus on that. And we're evaluating actually the GE Vernova as well, which we got in the spin out. Whether we want to add to that, we're waiting for the quarter in a couple of days there.
And so, okay, so wait and see there. But when it comes to GE Aerospace, that standalone business, let's talk a little bit more about that in the context of Boeing. Because, of course, GE Aerospace, world's largest producer of jet engines, of course, that go into the 737 MAX, the 787 Dreamliner. I mean, what effect has that had on GE Aerospace that we can tell? And does that give you pause when you think about the struggles that Boeing is currently mired in?
Yeah, well, it certainly creates a headwind that would, otherwise the quarter would have been stronger. But, fortunately, GE supplies to both Boeing and Airbus. And as was mentioned earlier in the show, the demand for new jet engines and new planes is really insatiable at this point. Boeing's unfortunately had, many well-documented travails there. But, hopefully they eventually get it right, and that's going to be another kind of further boost, I think, for GE Aerospace. But at the moment, listening to the call, there's really no specific headwinds that they're pointing to that's going to change their guidance. As you said, they raised it actually for the year despite beating this quarter as well.
Yeah, beat and raised quarter for, of course, GE Aerospace. It's interesting. You have some analysts coming out and saying that actually GE stands to benefit here from what we're seeing going on at Boeing because, of course, airlines are going to have to be repairing and upgrading their existing fleets, and that should bode well. But we'll see how that plays out. Let's also talk about Lockheed Martin, because you were talking about this long turnaround at GE. When you think about what's going on at Lockheed Martin, it did top estimates. It reiterated its 2024 outlook, but I don't know, the stock, it's not reacting with too much positivity, and year to date, it's lagging the major indexes. What do you make of what's underway at Lockheed Martin?
Yeah, GE Aerospace and Lockheed Martin, both in the aerospace defense industry group, but in two very different circumstances, as you just alluded to. Lockheed's had some issues over the past year and a half, particularly with their F-35 program. And so that's created, some headwinds for them in terms of deliveries. But they did get a new contract with the Missile Defense Agency recently that was announced, about $17 billion. So I think they're kind of coming out of what has been a difficult couple of years. And if you look at the numbers for this year, it's still scheduled to be down on EPS, but reemerging in 2025 and 2026 with nice double-digit growth. So we like the name here. Relatively cheap valuation, especially compared to some other peers. It's got a good dividend, about 2.5%, so one of the higher yielding industrials out there, and we think they're moving in the right direction.
Well, when it comes to Lockheed Martin, I mean, how much of your thesis sort of rests on aid passing for Israel? Because, of course, Bloomberg Intelligence has theorized that if that package actually passes, of course, it's being voted on in the next couple of days, that could boost orders for the F-35. How are you thinking about that?
Yeah, well, kind of taking a step back from any specific, place of trouble like Israel or the Middle East. I mean, just unfortunately, the geopolitical backdrop in general, right, is creating a growth industry in defense. And so whether that goes through or not, I think, unfortunately, generally the orders, the backlogs are growing for all of these companies. Again, if they can get the F-35 program kind of running smoothly, we think that bodes well for their orders going forward.
All right, Walter, got to leave it there. Great conversation. Really covered a lot of ground. Our thanks, of course, to Walter Todd of Greenwood Capital. Now, still ahead, we'll take a look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg. All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, General Motors expecting more profits this year thanks to robust truck sales in the U.S. Now, that steady demand for pickup trucks and SUVs helping to offset weakness in China. The auto giant lost about $100 million in the region, which once accounted for $2 billion a year in profit. Next up, we have Apple trying to increase its toehold in the world of soccer. The tech giant reportedly close to a deal with FIFA that would give it TV rights for a World Cup-style competition that will take place next year. Now, if the deal goes through, it would mark Apple's second major broadcast partnership in the sport. And finally, we have the FTC saying that it will sue to block Coach-parent Tapestry's deal to buy Michael Kors owner Capri. This is the first time that the Biden administration has used its antitrust enforcement to try and stop a deal in the fashion industry. Regulators say the deal would raise prices on handbags and accessories in the affordable luxury space. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Let's take a quick look at the market right now because an interesting turnaround after, of course, those manufacturing numbers from a little bit earlier. You can see the S&P 500 currently up about 0.9%, even more so if you take a look at big tech. The Nasdaq 100 higher by more than 1%, and yields continue to move lower quietly, down about 3 basis points on the 10-year. Now, coming up, as I was saying, U.S. business activity cools in April. We'll speak to Raveen Gandhi, GMM Non-Stick Coating CEO, next. This is Bloomberg. data this morning showed that the S&P Global U.S. Manufacturing PMI dropped to a 4-month low in the latest reading. Natalia Konijevic is here to break it down.
Hi, Katie. Yes, so PMI dropped to 49 point. That's the other chart we will show you in a second. 49.9 in April, down from 51.9 we saw in March. So we see some signs of demand weakness. And it's interesting that U.S. producers, they drew down stocks of purchases for a second consecutive month. Inflation picture is really interesting as well. We see that inflation keeps rising, but the pace is decelerating a little bit, and drivers of inflation are changing a little bit. We see that U.S. producers are now facing higher costs, and they are coming from higher raw materials as well as higher energy prices. That's in contrast with services inflation we saw last year, and that was mainly driven by wages inflation. And of course, we see that demand weakness also impacts hiring plans. That's mostly for U.S. services sector. That's the chart that shows U.S. manufacturing PMI dropping to 49.9 points. So demand weakness plans for hiring also decelerating, especially when it comes to services sector, and manufacturing employment continued to increase just modestly. Of course, we all want to know how this will be translated into the U.S. stock market. So far, so good. We see that earnings beat from the U.S. largest producers. We saw results from General Electric, Lockheed Martin, General Motors. But more broadly, if we compare the U.S. industrial stocks versus the S&P 500, we see that industrials are now outperforming, Katie, the S&P 500 on a year-to-date basis.
All right, Natalia Konijevic, thank you so much for that setup. And for more on the manufacturing picture, I'm pleased to say we're joined now by Raveen Gandhi. He is GMM Nonstick Coatings CEO. GMM, of course, is one of the world's leading suppliers of coatings to the cookware, bakeware, and electric appliance industry. Raveen, great to have you with me. And let's start with what we learned, of course, at 9:45 this morning from those PMI numbers, really reflecting some weakness, of course, in business activity. When you think about your customer base, who you work with, are you seeing that as well?
Not really. I would say that things, are still kind of hanging in there from my perspective. If there's going to be a downturn, I expect to see it probably for us in the next 60 days, because that's when we see a material spike in my business for the summer, which ends up being all the goods that are produced for Christmas. But so far so good.
It's pretty wild that, of course, in 60 days' time, that's when the Christmas season starts. But of course, if you are someone who actually makes things, that makes a lot of sense. So that's the side when you think about the actual businesses. But tell me about the American consumer, especially as we gear up for some of these key shopping milestone times. I mean, when you think about inflation in this country, it's disappointed a lot of people, policymakers included. Is that weighing on the American consumer?
It's just such a hard question, because we have seen a tremendous bounce in 2024 in my business versus 2023 in the face of all of these high rates. And now, of course, everyone is saying that rates are going to stay up longer or later. And we've seen a little bit of a sell-off, but so far, people are hanging in there. Now, I could go on and on about what I think, from a governmental policy failures we have had. But for the moment, the U.S. consumer is still pretty strong. And I would also say that, I'm in this kind of soft landing camp, but I'm also in the camp that says, don't cut rates too soon, because you can always cut them later if the data, indicates it.
That's really interesting. And so you're still in the soft landing camp. I mean, how much harder has that position gotten over the past few months? How are you thinking about the fact that, okay, things are still pretty robust, the economy is growing, but there is that concern, it sounds like you don't necessarily share it, that if we keep rates higher from at this point, eventually it's going to hit the labor market, it's going to hit the growth picture?
Yeah, I mean, if you look at maybe my last 10 appearances on Bloomberg, I've probably been somewhat bearish in eight or nine of them. So I'm generally a pretty big skeptic in terms of I always am looking for dark clouds on the horizon. But at this point, I really am impressed with the strength of the consumer. I mean, you could not have thrown more things at the American consumer between 2022 and 2023. And the fact that most companies are printing beats is really amazing, particularly in the U.S. I mean, if you look at what's happening in China, I think that's a disaster. But from an American perspective, I think that, the American consumer is pretty strong.
Well, we're going to get to China, but before we leave the U.S., you talk about that strength, resilience, other people would call it that, of the American consumer. And how is that affecting your thinking when it comes to potentially raising prices on your end? How are you thinking about how much sort of pricing power you have left at this point?
Well, I usually have pretty low pricing power because all of my clients are these big multi-billion-dollar corporations that have huge, sophisticated purchasing apparatus. And, they really don't like price increases. We've seen our raw material inputs go up about 4% this year. Now, we have been able to absorb that because we have, big teams of R&D people who are always trying to use value engineering to keep our costs going down by using different materials, by using, trying to get the same quality with lower prices. But if we get another raise, if we get an unexpected another raise this summer, or in Q3, we will pass that through. And if we do pass it through, then it's the game theory shifts to my clients. And will they absorb it? Will they be able to get Walmart or Target or Amazon to say, yes, let's raise prices? And that's finally when it hits the U.S. consumer. So it's on a long delay. In years like 2022, when we were getting shocking inflation, everything was accelerated. But for right now, people are pretty confident based on what we've seen the last couple of quarters with demand.
So we'll have to stay in touch on that point. And of course, I appreciate you laying out the daisy chain of you raise prices, but there's a few steps before it actually hits the end customer. But let's talk about China. You said it's a disaster. What does that actually look like? What does disaster mean?
For us, a disaster means, I would say, absolute demand reduction from the local markets, 30%, some, 35%. A lot of our clients, so just from a supply chain perspective, a lot of our multi-billion-dollar American clients, they place orders with Chinese factories, then order from my Chinese factory. And so these Chinese factories, besides supplying for the Americans, a lot of them make private label stuff that are used in the local markets there. And that demand has just absolutely fallen off a cliff. We've actually seen factories that employ thousands of people that we've known for many, many years have not opened up again after Chinese New Year. Mm-hmm. So for anyone who knows China, those factories opened up about 30 days ago. We've had people who have declared essentially Chapter 7, where they're liquidating their factories, selling off equipment. It's very, very dramatic what is going on from a local demand in China perspective right now.
It's a fascinating point that it seems like China is an issue for everyone right now, whether you're Tesla, whether you're Apple, or whether, of course, it's some of your customers that you're talking about. It seems like that cuts across industries. But really quickly, in the time I have left, are there any countries that are stepping up to fill that void? What about India, for example? There's a lot of optimism around India.
Yeah, I have a lot of investments in India. I'm very bullish on India. GMM has a large factory in India. And besides that, I get texts and calls from a fair amount of clients almost on a weekly basis saying China, beyond being too expensive, okay, first of all, too expensive in China, everybody hates the geopolitical risks in China for obvious reasons. It doesn't matter whether Biden stays in office or Trump gets in office. They're both very anti-China right now. So I do think India is a good place to be. I think that it's an extremely pro-business country. And I can only hope that the U.S. keeps going pro-business as well.
All right, Raveen, that's a good place to leave it. Really appreciate your time today. Our thanks, of course, to Raveen Gandhi of GMM Nonstick Coatings. And we are about an hour into this U.S. trading session, so let's get a check on these markets, and we're going to do that with Bloomberg's Abigail Doolittle.
Well, we're looking at pretty solid gains here for the S&P 500 and the NASDAQ 100 today, Katie, on those weaker than expected PMIs, the manufacturing PMI coming in at a 49, somewhere thereabouts below 50, in contraction, perhaps giving investors hope that the Fed will be cutting this year, and maybe 2 or 3 times, as opposed to not cutting at all. Take a look at the NASDAQ 100 at session highs, up 1.3% over the last 2 days, up more than 2%, the best 2 days going back to early March. The S&P 500 up about 1.5% over the last 2 days, the best since late February. So the recent declines we've had not out of nowhere, given the fact that these are, again, the best days in about 2 months. As for what's happening beneath the hood, let's take a look at some of the big movers, and it's all about earnings. Tesla will be kicking it off for these big tech movers this week, up 2.7%, the first up day in 8. The big selling pressure we've seen on shares of Tesla really getting a little bit of a reprieve. On a year-over-year basis, earnings and revenue are both expected to decline significantly. Lots of folks wondering, what will Elon Musk say in terms of trying to reinvigorate enthusiasm for Tesla? Meta up 2.75%. They report this week as well. Microsoft and Alphabet, and it should be pointed out, Meta and Microsoft, Alphabet to some degree too on earnings, very, very solid growth. Meta, we're looking at 66% year-over-year growth for earnings, Katie. That said, let's put all of this strength, the last 2 days, into the context of a chart that we've looked at before. So this is the NASDAQ 100, and you can see that the uptrend started to break. This is when the buyers became less confident, the sellers are a little bit stronger. Below the 50-day moving average, below the 100-day moving average. Today, back above it. But this area here is pretty heavy looking, so it's going to be very important to monitor this to see whether or not these bulls can continue. I suspect it may not last, Katie, but again, let's wait for all of the earnings to come out.
Yeah, it's going to be fun to watch those lines move around potentially over the next 2 weeks or so. Bloomberg's Abigail Doolittle, thank you so much. Now, coming up, global cooperation and infrastructure investment. The president of the Asian Infrastructure Investment Bank tells us how multilateral development banks work together to address issues such as climate change. This is Bloomberg. It's time now for our daily Wall Street Week conversation. And the World Bank has some help in promoting global economic growth. Multilateral banks focused on infrastructure step in to unlock capital necessary to fund new projects. Jin-Lee Chun is the president of the Asian Infrastructure Investment Bank, and he sat down with Wall Street Week's David Weston to help explain his bank's role.
Asian Infrastructure Investment Bank is a multilateral development bank. It's MDB. In terms of the governance, management, practice, it's more or less the same as the other multilateral development banks. I would say it remains in the gene pool of the MDBs. The difference is it's a bank created in the 21st century with a clear mandate to improve infrastructure investment so as to improve the regional and global economic integration. So infrastructure for connectivity, infrastructure for tomorrow is the key. As you see, the Bretton Woods institutions, World Bank, IMF, they cover the whole world. And in the ensuing decades, other banks were created, such as Asian Development Bank, EBRD, European Bank for Reconstruction and Development, and the Inter-American Development Bank, African Development Bank. All these banks are considered regional banks. They focus on the regional development in spite of the fact that members could be beyond the region, non-regional members as the shareholders. We intend to be focusing on Asia, but without limiting ourselves to Asia.
How do you work with the other MDBs?
We work very well in collaboration with the World Bank, with ADB, EBRD, and other banks. Because you see, the development need is so vast that no single MDB can handle this on their own. So it is very much important to make sure that MDBs work as a system. We work together as a system so that we can deal better some of the global challenges like climate change, right? So let me give you some of the examples of our cooperation. We provide $1 billion guarantee to the World Bank so that they can release the money, because our guarantee, they can release the money and to do new investments. So this is considered a very close cooperation because we are adequately capitalized and we can help them. And Inter-American Development Bank is also interested in working with us like that. It's a win-win, right? We build up our assets quickly and they have new capital to invest in new projects. And working as a system, all of the MDBs can manage to unlock $400 billion of capital to promote investment in climate change mitigation, adaptation, infrastructure development, lots of important things which we can do together.
To what extent do you work with the private sector to further leverage the capital that you're talking about? There's a lot of talk in the United States, at least, about private-public partnerships when it comes to infrastructure.
We make a point of working with the private sector. We try to crowd in the private sector for the purpose of dealing with development challenges. But you see, private sector would be very much sensitive to the investment environment, or you say investment climate of a country. So give you one example. We are working on providing support to the member countries to improve their regulatory and macroeconomic situations so that the enabling environment for green economy, for net zero transition would be accelerated. And so if the enabling environment is improved, the private sector people would feel comfortable to move into a country and put money there. And this is what we are going to do. You see, in addition to individual projects, we work with the private sector. So there are lots of things which we can do, dealing with the capital market, mobilizing resources for climate change projects. So I think our bank is exploring new instruments so that we can do better to crowd in the private sector.
What is the profile of the countries that typically you're lending into? I mean, you said it's Asia, but we have middle-income countries, we have low-income countries, we even have concessionary below low-income countries. What's the profile for you?
We finance development projects in low-income countries, mid-income countries, even higher income countries in the developing world means. The purpose of doing this is twofold. One, we believe the development in individual countries are interrelated. And if we can help the middle-income country, for instance, to develop infrastructure, connectivity, they can have spillover effects on lower-income countries. Likewise, if we support the low-income countries, that would create even more opportunities, better opportunities for the neighboring countries.
And that was Jin Liqian of the Asian Infrastructure Investment Bank and Wall Street Week's David Westin joins me now. And it was interesting hearing him describe this system that they have and working in concert with the other multilateral development banks.
Yeah, there are so many of them, aren't there, really? Aren't there? But you wonder about how they free up the capital, because that's one of the big issues. There's a lot of capital out there, but they can't quite free it up. The idea is this will unlock it. And you heard what he said was they think they have an advantage because they're focused. It's infrastructure in Asia, and also they're newer. They're younger. He didn't talk too much about it, but they're somewhat leaner and they're still focused on a specific mission, whereas some of the other development banks have expanded out their missions, have a lot of other ancillary operations.
And when it comes to unlocking this capital and getting it actually committed to projects, I mean, what kind of timeline are they operating on?
What he said was that their goal is to try to get things approved within a year and money out the door in less than 2 years, 18 months or so. And one of the challenges they have is sometimes there aren't enough really good projects to fund. They have more projects, they have more money than they have to fund, but they're trying to get it done fairly quickly. And you also heard an emphasis on climate, because that's one of the things they're really focused on, is infrastructure, but infrastructure to support some of the move toward a greener world.
So a big focus on climate there. And I thought the conversation that we were having at the end when it comes to the issue of poverty, of course, how do you balance the focus on lower income versus middle income countries? It sounds like something they discuss a lot.
Exactly. And their approach, again, is a little bit different from, for example, the World Bank, which may go directly at the poverty issue. Their approach is if we can get development going in the middle income countries as well as the lower income countries, there could be a spillover, and that will help in the development front. They're not going straight at the development. They're doing it through the infrastructure lens, sort of a way around to try to bring everybody up.
Well, it's a great conversation. It'll be interesting to, of course, track their progress there. But who else do we have coming up?
Well, tomorrow we're going to talk to Wes Edens, a famed investor. Among other things, he founded New Fortress Energy. We're going to talk to him about what's going on, particularly in the liquid natural gas area. He's very active in that space. And what he thinks where the energy market's going globally. That's Wes Edens tomorrow.
All right, a lot to look forward to there. Our thanks, of course, to David Westin. This is Bloomberg.
season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
All right, let's take a look at some stocks hitting highs this morning. And we start with defense giant RTX hitting a 52-week high after reporting profits and revenue that beat estimates, thanks in part to strong demand for missile defense systems. Currently, shares unchanged, some of those gains coming back. But then you take a look at GE Aerospace, also hitting highs after it reported positive results. The strong showing was driven by an increase in revenue from commercial aircraft engines and services. You take a look at shares currently higher to the tune of about 6% as the broader market rallies as well. The S&P 500 currently higher by about 1%, but of course, everything could change tonight when we finally get those Tesla earnings. Bloomberg Tech is coming up next. They're going to be all over it, but that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
Everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Apple faces its worst start to the year in China. That's since the COVID pandemic, as new reports show sales fell by 19% in the first quarter.
Plus, the Senate is set to consider the $95 billion aid package that could lead to a nationwide ban on TikTok, if not divested. We'll go on the ground to Washington.
And we push ahead to Tesla earnings after the bell as investors brace for Musk to nix the rollout of a cheaper model and refocus on developing a robo-tax. Shares already suffering their longest rout since 2022. We'll discuss that and so much more throughout this hour. But even as we sit with much anticipation of the earnings to come, we managed to see some risk appetite in the market today. Maybe the bad news is good news from a macro perspective today. Maybe some of that business activity actually cooling off more than the market anticipated means, well, we decide to go into equities as we think the Federal Reserve maybe has more space to be cutting in the second half of the year. NASDAQ currently up 1.5%. But remember, we've been beaten up, particularly at the end of last week. Two-year yield, big auction, $69 billion worth, record amount coming to the market, yet still yields managing to be falling today. That's as we see money move into some of the havens. We're seeing 4.93, there or thereabouts. So interesting that we've got equities rallying and indeed bond markets rallying on this particular day. Stoxx 600 over in Europe also having a stellar run on the moment. We're up a percentage point. Notably, UK, call out for them, the FTSE 100 currently at a new record high. That's actually as we see some of the haven stocks there actually do well amid some of the geopolitical tensions. When we have a look overall at money moving into both risk asset classes and indeed to good old Bitcoin. We're up 0.4% at the moment. We're currently at 66,849, so well off the highs, but still money coming in despite a relatively strong dollar. Ed, what have you got coming up on the micro?
Earnings and a lot of individual tech names. Tesla's getting a boost ahead of earnings after the bell. We will play or get ready to play Tesla Bingo. Tune in at the end of the show to find out what I'm talking about. Spotify, swing to profit, strong subscriber growth. Bloomberg's Ashley Carman's going to join us. This is a name that a lot of people watching. Look at the big jump in the shares. And then Adobe's higher. It's the 1 year anniversary since Firefly was released. I think there's big questions about particularly text to video generation. We have a key interview with an Adobe executive. Then there's Apple. So Apple's interesting. We're now higher, maybe 0.4% in the session. We had opened lower, but basically we're trading at the same level on Apple we were 1 year ago. It has been a difficult start to the year, concerned principally about China. Third-party data, Counterpoint Research, shows that iPhone sales in China down 19%, 1.9. More interesting, perhaps, is the other data outside of Apple, showing domestic handset makers gaining market share. Apple has fallen to third, and it's on par with Huawei, which is kind of resurgent at the higher end of the smartphone market. The data doesn't seem to be worrying anyone right now. We continue to push higher in the session, but big picture ahead of earnings later on next week. Apple in focus. Let's talk to none other than Bloomberg's chief Apple correspondent, Mark Gurman. We stress third-party data. It is not Apple telling us this, but there's a bit of concern that China's still the key battleground and the iPhone is losing ground, Mark.
This is exactly what Wall Street and investors have been bracing for, another big decline in China. As you know, Apple had its biggest decline in a couple of years last quarter related to overall China sales. And now it looks like you're going to see another decline in China given this data from Counterpoint Research. Now, as I typically say, these data points are typically not exactly on the money, but they're usually directionally correct. So if they're telling us that iPhone sales in China are down by a fifth, I would believe that iPhone sales in China are down quite considerably, not maybe as bad as 19%, but in all likelihood, they're going to be down, bringing down the overall picture in China. Now, why is that particularly interesting? Because even though China had about a $2 billion decline in the prior quarter, Tim Cook on the earnings call said that's not because of the iPhone. It's because of Apple's other products that they sell in China. Well, this time around, it's likely because of the iPhone if these numbers are to be believed.
Let's talk about other products because we kind of got signaling on all of this before, IDC and other third-party data giving us a similar picture. What's new on the day, Mark, is that, well, May 7th, we got a new event and it's all around those new iPads.
Yeah, as I've been saying on here and on Power on the last several weeks, Apple is set to launch its biggest revamp to the iPad in over 5 years. You're going to see new versions of the iPad Air and the iPad Pro introduced on May 7th. They're going to play a video on their website. They're trying something new here, a video starting time of 7 a.m. versus the usual 10 a.m. And they're announcing this video well in advance. They've been trying some different things lately. Their usual cadence is to announce these things 7 days in advance. So now we're getting a full 2 weeks, which is quite interesting. Maybe they want a little bit more momentum leading into that. They're trying to see for these smaller scale launches if more advance notice brings in more people. So this is certainly something to look out for. New iPad Pro, new iPad Air, new Apple Pencil, new Magic Keyboards, all coming about 1 month before they announce their new AI initiatives at the Worldwide Developers Conference in early June. So this is going to be significant, and the hope, if you're on Wall Street or a shareholder of the company, is that this is going to boost iPad sales, which have been down quite considerably the last several quarters due to a lack of any updates across 2023.
And therein lies a lot of the issue, a lack of update and certainly weakness in China. Mark Gurman always telling us it first. We appreciate it. Meanwhile, let's continue the conversation now on basically where you should sit with Apple when you're an investor. Ayoko Yoshioka, sorry, get my words out today, portfolio manager over at Wealth Enhancement Group, in the house with us. Ayoko, when you're looking at Apple, when you've seen some of the weakness, the worries about product updates, about perhaps behind the curve when it comes to AI, is this still such a solid name that you cannot avoid but to remain allocated to it? Or do you start to take some risk off?
It's a great question, Caroline. So, when we look at Apple, it is a great company. It's got a high quality balance sheet. There's so much cash on their balance sheet, and that allows them to buy back a lot of stock. It's a big position within the S&P 500 index. So it is difficult to not own it, and yet we do start to see some of these issues with Apple in terms of innovation and then being able to really bring new products that can continue to grow at the pace that they have been growing over the last several years.
And I think this is some of the tension we're seeing across the so-called Magnificent Seven, those that are deemed less than magnificent, for some still managing to do very well. When we're worried about a Tesla and Apple, which in many ways have very similar issues, China weakness, competition coming from China, worries about ultimately a lack of an update from a product, is it more therefore you have to look at valuations rather than trying to see a narrative as to when you get the next product?